please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
But the news coming in from both the pharma experts is that clearly there are a couple of good things going for the pharma space. Though Malik warns us that you should first look at the second and third quarter numbers. But that a stock that's been having all of us worried is Jet Airways. It's been in focus in the past few weeks for all the wrong reasons and is expected to declare its results now on the first quarter results, that is, on the 27th of the month. We have a look at, what are the building blocks and what are the red flags we should worry about. First, we have Sonia Shenoy. She's not with me anymore in the anchor desk. She's moved over to our analyst desk. And she's going to look at first the balance sheet stresses. And then we have a little more analysis of the stock. Sonia Shenoy, first, the balance sheet stresses.
Well, Lata, there are two key problems for Jet Airways, right? We all know them, the balance sheet stress and the P&L stress. I'm going to first talk about what's going wrong with the balance sheet. Now, on the face of it, the debt is reducing, so it appears as though things are getting better, but the devil really is in the details. So if you look at just the core numbers, the net debt as of June 2015, as per the company's statements, was at about 11,000 crores. It has fallen to 8,150 odd crores. But the real detail to look at is the net trade payables, and the trade payables have risen substantially for Jet Airways over the last many years. What this means is that they are unable to pay their suppliers. The suppliers' dues have been mounting. So just look at the trade payables, the graph that will come up for you. In 2018, the trade payables have risen to 5,400 crores. In 2011, it was less than 1,400 crores. This is a quadrupling of trade payables over the last 7 years. Now, also, if you look at, the borrowings and the repayment, the company just has no liquidity to make any repayments. So they are, borrowing at a very high coupon rate to make their immediate repayments. If you look at the numbers, I mean, in FY18, they borrowed about 1,250 odd crores. They repaid about 2,000 odd crores or so. In FY17, they borrowed close to 4,000 crores to make a repayment of 5,000 crores. So that's the kind of mounting dues that they have to their suppliers. Now, that is the reason why, you've seen all of these issues like non-payment of salaries, extending the credit period to 3 months, etc., and delayed repayments as well. That is the balance sheet stress that the company is facing. If you look at the P&L stress as well, if you compare it with peers, Jet Airways is in a really bad shape. For the last 5 out of the last 8 years, Jet Airways has been loss-making. Even if you look at FY18, for example, Jet Airways reported a revenue of 24,000 crores. Indigo reported the same revenue of 23,000 crores. But Jet Airways saw a loss of 630 crores, while in the same year, Indigo reported a profit of 2,240 odd crores. So what is Jet doing so bad that the others are not? If you look at, the key internal, which is RASK minus CASK. Now, just to explain this in simple terms, it's the revenue minus the cost per seat kilometer. The others are able to manage it just fine, but Jet Airways has been struggling on that account. Now, Indigo, for example, earns about 3.6 rupees per kilometer from every passenger. They spend 3.15 rupees per kilometer to, to sort of earn that 3.64 rupees. So, in general, they're making a profit there. Jet Airways earns more than Indigo. They earn 4.21 rupees for every passenger because of its premium offering, but they spend 4.49 rupees per kilometer. So, as you can see, this is what is really leading to the loss for Jet Airways. Even if you look at the standalone revenue per seat kilometer for Jet Airways, it has been on a declining trend for the last many years. Now, this warped cost structure is really at the core of Jet Airways' problems. A bloated cost structure and poor management has been cited as reasons for that. So overall, market share decline, balance sheet pressure, and higher trade payables is the reason why, there is so much concern over what Jet Airways can do in order to solve these problems.
Very quickly, anything on P&L you want to add?
Well, yes, on the P&L, as I said, these are the various issues. I just want to also talk about the substantial market share loss that Jet Airways has seen over the last 5 years. The market share of Jet Airways plus Jet Light has fallen from a high of 22% in 2014 all the way down to 15.9%. And, the question that everyone's asking is what are the steps to avoid a hard landing? Now, first is the immediate need of the hour, of course, is fundraising, maybe through a strategic equity sale, pairing of their debt. Remember, debt and net payables form 50% of their revenues currently. The EBITDA margins need to be driven higher. They are almost 300 basis points lower than Indigo, even as as late as FY17 and FY18. So just these are a couple of things that need to be sorted out for Jet Airways. On Monday, they will be announcing their numbers. They will also talk about cost reduction efforts. So let's see what comes out.
Okay. Well, thanks a lot for that exhaustive and comprehensive set of numbers that that have brought Jet